Hello friends, welcome to Wow IS. This is the part 3 of the May 2023 current affairs, and in this we are going to cover the economy portion. Now before moving ahead, I just want to tell you about our initiative. In this initiative we are creating crisp summaries of the Vision monthly magazine from April 2023 to February 2024, and it will be available only at a price of 599 rupees. This package includes your summaries for monthly magazine within 50 pages on an average, plus video lectures that I am providing to you. So you can avail these benefits at a rate of only 599 rupees. To enroll in the course, you can directly pay through this QR code and send us the payment details. Also, to subscribe, there is a link given in the description of the video. You can use that link to subscribe in this initiative. Now let's move ahead for the economy portion. So the first news here is Competition Amendment Act 2023. So the Competition Act has been amended, and there are provisions that have been provided. We shall discuss those provisions. First of all, we want to know about the Competition Act. The Competition Act 2002, it replaced the MRTP Act of 1969 and established the Competition Commission of India. The act's purpose was to forbid anti-competitive agreements, corporate abuse of dominant positions, combinations, and that are likely to have a materially negative impact on competition in India. So basically, the mandate of the act is to prevent any kind of negative impact on competition in India and to protect the interest of the consumers. Now, what amendments have been included? First amendment is the definition of combinations. It has been expanded. Mergers, acquisition, amalgamations of enterprises, all these are now included, and any transaction that is above value of 2000 crore rupees is now will be considered as a combination. Next, reduction in time limit for approvals. The time for approval of combination has been reduced from 210 days to 150 days. That means it has been now brought to 5 months. And prima facie opinion has to be established within 30 days. If the CCI does not give any verdict within the 30 days, then it will be assumed that a combination has been approved by the CCI. So it is going to improve the business climate in the country. Third, expansion of scope of charters to include hub and scope arrangement. Companies which are not engaged in identical or similar business activities can also be held liable for anti-competitive horizontal agreement or cartelization, where they participate or intend to participate in facilitating such agreements. Now, something about Competition Commission of India. Its duty of the commission is to eliminate practices of adverse effect on competition, so to protect the competition in country, promote and sustain competition, protect interest of the consumers, then ensure freedom of trade in the market of the India. It comes under Ministry of Corporate Affairs. The chairperson, there is a chairperson, at least 2 to 6 other members are there. The chairperson shall be appointed by the central government, and the tenure of the office of the chairperson and members is 5 years or age of 65, whichever is earlier. And they are eligible for reappointment also. The powers you already know, it can regulate own procedure and amend the orders to rectify any mistake. Failure to follow commission's order or direction can result in fine or imprisonment. So these are the powers with the commission. Now, the grievance redressal and penalty provisions have also been added in this Amendment Act. It says that any complaint for anti-competitive conduct need to be filed before or within 3 years from the date on which the cause of action arose. The CII is empowered to condone delays. Next, the penalty has been increased from 1 crore to 5 crores. Penalty will be based on the global turnover, not on the domestic turnover. Then the leniency regime, where a party implicated in the cartel investigation make a true and vital disclosure of an alleged violation or another undisclosed cartel, CCI is empowered to grant an additional lesser penalty for cartel already being investigated. Then the CA changes the nature of punishment for certain offenses from imposition imposition to fine or to penalties. So now the punishment has been changed to fines or penalties. Next is other provisions of this Competition Amendment Act, settlement and commitment mechanism. Under this mechanism, the CCI may initiate proceedings against enterprises on the grounds of anti-competitive agreements. CAA permits CCI to close inquiry proceedings if enterprises offer settlement or commitment. Next, implementation of open offer or purchase of shares. CCAA permits the implementation of an open offer or acquisition of shares or securities through transaction on a regulated stock exchange before CCI approval. Then the appointment of Director General. The DG will be appointed by CCI with prior approval of the central government as against the erstwhile powers being vested with the central government. So now the CCI will be the Competition Commission of India will be responsible for appointment of the Director General. Then what is the significance of this amendment? First of all, it will allow for speedy approvals. A fair competition regime has been established. Now, any transaction exceeding 2,000 crore threshold will be requiring CCI approval. Then it also goes for higher penalties. It increases the jurisdiction and also goes for a faster resolution. So these are the significance of the amendment. Now next article with us is the London Interbank offer rate. LIBOR and MIFOR, that is Mumbai Interbank forward outright rate, will be phased out by June 30. MIFOR is a domestic interest rate benchmark which is published by the Financial Benchmark India Private Limited or FBIL. Now, what are these benchmark rates? LIBOR is a global benchmark interest rate at which major global banks lend to one another. That means that if the banks have to take loans from another banks, then this LIBOR interest rate will be applicable to them. So this is for a short-term loans in the international interbank market. Prior to 2014, LIBOR was administered by British Bankers Association. Later on, UK Financial Conduct Authority has taken over this task. Now calculation, with December 31st, 2021, LIBOR was calculated for 5 currencies: US dollar, Euro, Pound, Swiss franc, Japanese yen for 7 tenors. After announcement of phased rollback in March 2021, only US dollar LIBOR will be allowed to be published. Now something about Financial Benchmark India Private Limited. It is jointly owned by Fixed Income Monthly Market and Derivative Association of India and Foreign Exchange Dealers Association of India and Indian Banks Association. So 3 entities are the joint partners in this Financial Benchmark India Private Limited. It was formed in 2014 as a private limited company under Companies Act 2013. The basic aim was to develop and administer benchmark relating to money market, government securities and foreign exchange in India. It is regulated by Reserve Bank of India and the functions are collection and submission of market data and information including pooled data, formulation, adoption and periodic review of benchmark calculation methodologies and calculation, publication and administration of benchmark. These benchmark means interest rates. The simple meaning is interest rate. This is the interest rate at which one bank is lending to the another bank. So ये वो ब्याज है जिसके ऊपर एक बैंक दूसरे बैंक को lend करता है. Now next is alternatives. What are the alternatives to LIBOR? US secured overnight financing rate, Europe's European interbank offer rate, then Japan's Tokyo interbank offer rate, China's Shanghai interbank offer rate, then India's modified Mumbai interbank forward outright rate. Next article is Liberalized Remittance Scheme, LRS. RBI's Liberalized Remittance Scheme, the Finance Ministry will also include overseas use of credit card by Indian residents within a limit of $250 million. Now, there will be tax collected at source will be applicable on this. This TCS is a type of tax collected by the seller of the goods and services from the buyer in the context of foreign remittances transaction, and this tax is collected when individuals send money abroad. Next, Union Budget 2023-24 proposed a 5% TCS on foreign remittances exceeding 7 lakh towards education and medical treatment. Similarly, it proposed no change in 0.5% tax TCS on foreign remittances exceeding 7 lakh towards education through loans from financial institutions. About LRS, until now a provision in the Foreign Exchange Management Current Account Transactions Rules 2000 excluded Indian residents' overseas use of credit card during foreign travel from 250 million to 2.5 million US dollar cap. Debit card transactions abroad are already accounted for in the LRS. Now, what these rules say? Under FEMA, all residents are free to buy or sell foreign exchange for any current account transaction except for those transactions which withdrawal of foreign exchange has been prohibited by the central government. If we go for the background of LRS scheme, it was introduced in 2004 to liberalize the existing foreign exchange regulation and facilitate the smooth transfer of funds abroad by Indian residents. Under LRS, all resident individuals are allowed to freely remit up to $2.5 million per financial year for any permissible current or capital account transaction or a combination of both. Individuals require prior permission of RBI to make any remittances above this threshold. The scheme is not available to corporates, partnership firms or HUF or trusts. So it is only available to individuals. Now, remittances can be made in any freely convertible foreign currency. What are the prohibited remittances? Remittances that come under Schedule 1 or restricted under Schedule 2 of FEM CAT rules. Trading in forex is also prohibited. Capital account remittances are also prohibited for the non-cooperative countries. Now, to those individuals or entities which are identified as posing risk to or committing of terrorism, they are also prohibited. And for gifting to another resident in the foreign currency is also prohibited. What are the permissible remittances? Private visits for any country except Nepal and Bhutan, gift or donations, going abroad for employment, emigration, the maintenance of close relatives abroad, travel for business or conference or specialized training or for medical expenses and studies abroad are allowed. Now, next is insurance sector. Bima Trinity will include Bima Sugam, Bima Vistar and Bima Vahaks. Bima Sugam means integrating the insurers and distributors on one platform. It will act as a one-stop shop for customers where the consumers can take anything. Then Bima Vistar means a bundled risk cover for life, health, property and casualties or accidents. Will have defined benefits for each risk and can be paid out faster than the usual without need for surveyors. Women-centric workforce in each Gram Sabha will meet the women heads of each household to convince them about benefits of the composite insurance scheme. Then what are the draft guidelines for Bima Vahak? Our IRDAI has issued draft guidelines for Bima Vahak. The objective is to establish a dedicated distribution channel focused on enhancing insurance inclusion and creating awareness in every Gram Panchayat. Guidelines define two types of Bima Vahak, corporate Bima Vahaks and individual Bima Vahaks. Next, what are the scope of activities assigned to Bima Vahak? They include collecting proposal information, KYC compliance, coordination and support in policy, claim related servicing and facilitating premium payment processes. Current status of insurance in India. Total premium India is the 10th largest market globally with an estimated market share of 1.9%. Insurance density in India, it has increased from $11.1 in 2001 to 91 in 2021. Life insurance $69 and non-life insurance at $22. If we talk about insurance penetration, it has increased from 2.7% in 2000 to 4.2% in 2021. Insurance penetration in life insurance sector was 3.2% in 2021, twice more than the emerging market and slightly above than the global average. That means our insurance footprint is now increasing. Now, growth drivers for insurance sector in India: favorable demographics. 55% of Indian population is in the age group of 20 to 59, that is working age group. In the year 2020, an estimated reaches 56% of the total population by 2025. This point towards a young insurable population in India. Wide middle class expansion. By 2023, India will add 140 million middle income and 21 million high income households, which will drive the demand and growth of Indian insurance sector. Then digital behavior patterns. Agents' ease along with citizens' ease in digital tools has grown. Now, IRDI, that is Insurance Regulatory and Development Authority of India, it comes under Ministry of Finance and Department of Financial Services. It is a statutory body formed under IRDAI Act of 1999. It grants licenses to insurance companies, insurance intermediaries. It protects interest of policy holders. It regulates investment of funds in insurance companies, professional organizations connected with the insurance business. Also undertakes inspection and conduct inquiries and investigations in the entities connected with the insurance business. Then entities regulated by IRDI: life insurance companies, general insurance companies, reinsurance companies, agency channels, intermediaries. So all these comes under the regulatory ambit of the IRDI. Now, what is the related news? One is a surety bond. It is a type of insurance policy protecting parties involved in transaction or contract from potential financial losses due to breach of contract and other types of non-performance. Insurance Information Bureau of India. Russian hackers encrypted IIB's data through a ransomware attack. Then Insurance Information Bureau of India. It was established by IRDAI in 2009 and formally inaugurated in 2010. It is registered as an independent society under Andhra Pradesh Societies Registration Act in 2012. It acts as a single platform maintaining a repository and analytics in the reinsurance sector related information in India. Other key information that includes provides a bundle of services related to motor insurance to multiple stakeholders, spearhead mortality and morbidity investigation center operations, handles central index servers which act as a nodal point between different insurance repositories, maintains a registry of all hospitals and network of insurance, that is Rohini. Now next is demographic dividend. Unemployment has fell down in the fourth quarter of 2022-23. It remained elevated at 17.3% against 18.6% in the third quarter. So now it is 17.3%. States like Rajasthan, Himachal Pradesh, Union Territory of Jammu and Kashmir have a 30% unemployment rate in the fourth quarter. Demographic dividend, if we talk about, so India is in the middle of a demographic transition. The fertility rate is falling. Then rising median age, that is 24 years in 2011, 29 years now, and expected to be 36 years in 2036. A falling dependency ratio, it has decreased from 65% to 54% in coming decade, taking 15 to 59 years as the working age population. Mechanism for growth in demographic dividend. So what are the mechanisms? Labor supply, then increase in saving. As number of dependent decrease, individuals can save more. So this increases the national saving rate, increases the stock of capital in developing countries. Human capital decrease in fertility rate results in healthier women and fewer economic pressures at home. Increase in demand and decreasing dependency ratio. What are the challenges in reaping demographic dividend? Generating sufficient employment opportunities, gender disparities, caste discrimination and religious differences, widening income gap, lack of access to healthcare services, low employability and informal economy. So these are the challenges for reaping our demographic dividend. Second demographic dividend. The first demographic dividend occurs during the demographic transition phase. The second demographic dividend results from an increase in adult longevity, which causes individuals to save more in preparation for the old age. This increase in saving can thus contribute to capital accumulation and economic growth. Now, what are the measures to reap the demographic dividend? First of all, health and education spending should be prioritized. Female workforce participation should be increased. There is need for governance reforms. Skill gap needs to be bridged through vocational training, internship, apprenticeship and apprenticeship degree programs. Then foreign capital inflows need to be increased need to be encouraged. India has a gross fixed capital formation of 33% of the GDP in order to meet its growth and job creation goals. This translates to capital requirement of US dollar 120 trillion over next 25 years. Transition from agriculture sector, India also needs to reduce its share of population that is dependent on agriculture. The next is ruralization in India. Ruralization refers to opening of rural areas to renew rural generation, jobs and farms. But in case of India, such trend is considered akin to deindustrialization. It refers to a situation where the productive capacity of the economy is distorted. Impact of ruralization. It is difficult for manufacturing workers to find new jobs, reduced tax potential in manufacturing sector, increasing income inequality as surplus labor results in low real wages, reduced economic growth overall, slower productivity growth. Then virtuous cycle of growth, progression of economy, poverty reduction, a productive employment and income, urbanization and rise in investment. Next is what are the indications of ruralization. Chronic lack of private investment. Share of private fixed capital formation has continued to decline from 10.8% to 8.4% in financial year 2022. Then persistence of unemployment problem. RBI's survey for urban household indicate that both employment and income situations have improved since COVID lows but has remained weaker than pre-pandemic and 10 years back, resulting in worsening of the per capita income amid the rising cost of living. Workforce shift towards agriculture. India's workforce dependence on agriculture has risen from 42.5% to 45.5% in 2021-22. And the real agriculture GVA has grown 3.8% on a 3-year CAGR basis, higher than 3.2% real GDP growth. Then demand for cereals rising again. India's monthly per capita consumption of cereals has contracted by 1.7% annually from 12.9 kg in 1993-94 to 10.4 kg in 2011-12. But the trend has reversed as reflected in GDP expenditure series on the cereals and bread. Then fall in industrial production. Industrial production growth in US has improved, but India's industrial growth fell to a 10-year average of 2.1% compared to 7.7% during 2011-12. Now, what are the initiatives that have been taken to avert this trend? One is production linked incentive scheme across 14 key sectors. Then PM Swanidhi to provide working capital loans to street vendors vending in urban areas. PM Gati Shakti, transformative approach for economic growth and sustainable development. Then Deen Dayal Antyodaya Yojana, National Urban Livelihood Mission to reduce poverty and vulnerability of the urban poor households. And Credit Guarantee Trust Fund for Micro and Small Enterprises, CGTMSE, to provide collateral-free loans up to Indian INR 1 crore. Then Pradhan Mantri Mudra Yojana, free loans up to the MSME. So for this, with this we conclude for the today. The second part of the economy will come tomorrow. So thank you very much and have a very nice day.